Hello everyone, welcome to Business School 101. A Ponzi scheme is a fraudulent investment scheme that lures investors with the promise of high returns, often in a short time frame. Instead of generating legitimate profits, the operator uses funds from new investors to pay returns to earlier ones, creating the illusion of success. It is named after Charles Ponzi, who became infamous for running such a scheme in the early 20th century. So who is Charles Ponzi, and what exactly did he do? What key characteristics do Ponzi schemes normally share? Are there some real-world examples? In this video, I will discuss these questions with you. Section 1. Who is Charles Ponzi? Charles Ponzi was born on March 3, 1882, in Lugo, Italy. In 1903, when he was 21, to seek better opportunities, he immigrated to the United States, with only $2.50 on his account. Ponzi's early years in the United States were marked by a lack of stable employment and brushes with the law, including convictions for check forgery and smuggling immigrants into the country. In 1919, Charles Ponzi initiated his notorious investment scheme. He lured investors with promises of remarkable returns, such as 50% in just 45 days, or a staggering 100% in 90 days. He claimed that these profits would be generated through arbitrage opportunities involving international postal reply coupons. Ponzi's scheme quickly gained immense popularity, as news of these extraordinary returns spread far and wide. At the pinnacle of his success, Ponzi was raking in approximately $250,000 every single day. However, behind the facade of prosperity, Ponzi was, in reality, using fresh investments to pay off earlier investors, creating the classic structure of a Ponzi scheme. The unraveling of Ponzi's scheme began when the Boston Post newspaper started investigating his operations in May 1920. The newspaper's articles raised questions about the feasibility of Ponzi's investment model and the source of his profits. As skepticism grew, investors began to demand their money back. In August 1920, Charles Ponzi's scheme finally collapsed as he was unable to meet the withdrawal demands of panicked investors. Thousands of people lost their life savings, and Ponzi was arrested and charged with numerous counts of mail fraud and securities fraud. Charles Ponzi died on January 18, 1949, in a charity hospital in Rio de Janeiro, Brazil, barely leaving behind the money needed to cover his burial. Section 2. Common characteristics. While Ponzi schemes can take various forms, they typically share common characteristics, which include the following. Number 1. Unrealistic returns. Be skeptical of any investment opportunity that promises consistently high returns that are significantly above the average market rates. If it sounds too good to be true, it probably is. Number 2. Lack of transparency. Legitimate investment opportunities provide detailed information about their investment strategies, assets, and financial performance. Be cautious if the promoter is evasive or unwilling to provide transparent information about how the returns are generated. Number 3. Consistent returns, regardless of market conditions. Be wary of investments that claim to generate stable returns, regardless of economic or market conditions. Legitimate investments typically fluctuate in value with market changes. Number 4. Pressure to invest quickly. Ponzi schemes often pressure potential investors to act quickly, claiming that the opportunity is limited or exclusive. Take your time to research and make informed decisions. Number 5. No audited financial statements. Legitimate investment opportunities often have audited financial statements prepared by reputable accounting firms. The absence of audited financial statements is a red flag. Number 6. Difficulty withdrawing funds. If you encounter obstacles or delays when trying to withdraw your money or receive returns, it could be a sign of a Ponzi scheme. Ponzi operators often use new investors' money to pay earlier investors, making withdrawals difficult as the scheme nears collapse. Number 7. Referral-based marketing. Be cautious if you are approached by friends, family, or acquaintances who encourage you to invest and claim to have made significant profits. Ponzi schemes often rely on word-of-mouth referrals. Section 3. Madoff's Ponzi scheme. Bernie Madoff ran one of the largest and most notorious Ponzi schemes in history. He was a respected financier and former chairman of NASDAQ. His scheme operated for several decades before it was exposed in 2008 during the global financial crisis. Madoff promised consistent, decent returns to investors through his investment advisory business. He claimed to use a proprietary trading strategy to generate these returns. In reality, Madoff did not invest the funds as promised. Instead, he used new investments to pay returns to earlier investors. The scheme collapsed when the financial crisis led to a surge in withdrawal requests that he couldn't meet. Thousands of investors, including individuals, charities, and institutional investors, lost $65 billion in the scheme. Bernie Madoff was sentenced to 150 years in prison for his role in the fraud. Madoff died at the age of 82 in a federal prison near Butner, North Carolina, in April 2021. Section 4. Pearlman's Ponzi Scheme. Lou Pearlman, a former music mogul, orchestrated one of the most infamous Ponzi schemes in the entertainment industry. Pearlman is best known for managing successful boy bands like the Backstreet Boys and NSYNC in the late 1990s. Pearlman's Ponzi scheme involved his two companies, Transcontinental Airlines and Transcontinental Airlines Travel Services. He promised investors high returns on their investments, supposedly generated from investments in the music and aviation industries. In reality, he was using funds from new investors to pay returns to earlier investors, a hallmark of a classic Ponzi scheme. The scheme began to unravel in the early 2000s, when investors and authorities started questioning its legitimacy. In 2008, Pearlman was convicted of conspiracy, money laundering, and other charges related to his fraudulent activities. He was sentenced to 25 years in federal prison and was ordered to pay millions of dollars in restitution to his victims. He died in federal custody in 2016. Section 5. Summary. A Ponzi scheme is a fraudulent investment scheme that lures investors with the promise of high returns, often in a short time frame. Instead of generating legitimate profits, the operator uses funds from new investors to pay returns to earlier ones, creating the illusion of success. The scheme is unsustainable and ultimately collapses, causing substantial financial losses to those involved. Named after Charles Ponzi, who gained notoriety for employing this scheme in the early 20th century, Ponzi schemes continue to serve as a cautionary example of financial fraud. Alright, that's all for today's topic. If you have any questions regarding this video, please leave your thoughts in a comment below. I hope you guys have enjoyed this video, and if you did, make sure you give it a thumbs up and subscribe to my channel. Thanks for watching, and I will see you next time.